Yep, you should probably never buy insurance for your phone. So why is that? First of all, from a mathematical point of view, insurance is never a good idea in the first place. It really is a game you are designed to lose. You see, the entire business model of insurance companies relies on a simple mathematical truth: collecting more in premiums than paying out in claims. They calculate exact probabilities of damage or loss and then charge you more than the expected value of potential claims. For example, and this is very simplified of course, but let's say that there is a 20% chance that your phone screen breaks in a given year. And let's say it costs $200 to fix. Therefore, the expected cost is $40 per year. And so insurance companies would make sure that it costs a good chunk more than the $40. Maybe 70 or 80 to insure your phone against the broken screen. And that's how they make money basically, and that's why mathematically insurance is never a good idea. But that brings up the question, why do we buy insurance at all? You see, for high value assets like houses, cars, the math becomes somewhat less relevant. A total loss would be financially devastating for most people. So even if home insurance, let's say, is mathematically unfavorable, we buy it because we can't afford to lose our house. We are not paying for expected value, we are paying to avoid catastrophic risk. But here's the key point. A phone doesn't, or at least shouldn't, fall into this category. For most people, replacing a phone is an inconvenience and not an existential threat. This means we can return to pure math and probability. And the math clearly shows us that phone insurance is not a good deal. Let's look at the hypothetical example. Francis the Fearful and Brittany the Brave. Both buy iPhone 16 Pros, which here in Europe cost 1,200 euros. For simplicity, we only look at catastrophic events, meaning your phone gets stolen or you damage it beyond repair. According to an American survey, to which I will come back later, the yearly chance of such a catastrophic event is about 8%. That's roughly a 22% chance of loss over 3 years. Francis is shocked by that number and after a quick Google search finds a popular phone insurance company from Germany. For a phone in this price range, they want 115 euros per year plus a 100 euro deductible per claim. As both Brittany and Francis want to sell their phones after 3 years, Francis is looking at an insurance cost of 345 euros. So if something catastrophic were to happen, he would pay a 100 euro deductible per claim and then would receive a payout from the insurance company depending on the phone's age at the time of loss. 100% of the new phone price in the first year, 80% between years 1 and 2, and 60% in the third year. Brittany, on the other hand, is very logical and says, well, a 22% chance for a total loss over the 3-year period means that there's also a 78% chance nothing happens to my iPhone at all. So the odds are very much in my favor. And to calculate which strategy is actually cheaper, I ran a Monte Carlo simulation with the help of Claude AI, testing a staggering 100,000 scenarios over 3 years. And for each scenario, we're checking every single day. You can imagine like rolling a 1095-sided dice each day, deciding if something is going to happen to the phone or not. And when there is a loss, we replace the phone at the current market price and therefore also accounting for phone depreciation. Here in this case, I used the data I collected previously for a video about the cheapest way to own an iPhone. Link is up here if you're interested in that. So, after simulating 100,000 scenarios, of which 77.94% had no loss at all, 20.25 had 1 loss, 1.76 had 2 losses, and 0.05% had 3 losses, we found that the mean cost with insurance is 1,209 euros, and without insurance it's 1,131.76. Now, that doesn't sound like huge savings for Brittany. But keep in mind that the mean average is skewed by extremely unlikely worst case scenarios with like 3 back-to-back losses right at the start costing over 4,000 euros. The median here is much more appropriate and we have 1,185 euros with insurance versus 840 euros without, which represents the most likely scenario, 78% chance where nothing happens to the phone at all. But we see that even when accounting for these extreme cases of bad luck and looking at the mean average, it shows that insurance still doesn't make any mathematical sense whatsoever. And Brittany is in fact right. Now, obviously there are a few limitations to this example. First, I calculated everything based on this one insurance company, and depending on where you live and what model of phone you have, premiums may vary. But you will almost certainly not find one that is mathematically cheaper versus no insurance over the long run. And secondly, 8% annual risk comes from a US survey where 8% of a sample size of a few thousand Americans reported the total phone loss over the last year. Now, a few thousand is not a whole lot of people, but more importantly, the survey was done by an insurance company. So if anything, the 8% figure is maybe slightly overestimated and not the other way around. But that only supports my point against phone insurance even more, because the lower the real risk, the lower the real number actually is, the financially better it is, of course, to skip insurance. And of course, the whole example here was only about total losses. With smaller things like screen repairs and camera repairs, you would save even more money when going the non-insurance route. I mean, even replacing the screen directly at Apple costs less than the insurance plus deductible. That's kind of wild. Alright, now that we know that phone insurance is probably not a good idea, what should you do instead, or what can you do to mitigate your risk despite not having insurance? So phones have become way more durable over the years. They generally survive falls from hip height, no problem. But of course, if you want to maximize protection and also plan on reselling your phone, screen protectors and cases are still the way to go. And in my opinion, with the exception of real bad luck, real fringe cases, they should mitigate the risk of severe accidental phone damage almost to 100%. Which means that you would pay your phone insurance mainly for theft, which probably shouldn't be more than a 2 or 3% annual risk. And then you oftentimes have travel insurance, home insurance that already covers such events. My next advice would be only buying as much phone as you can comfortably afford to lose. Remember in the beginning of this video I talked about how people buy insurance for houses, cars, in order to avoid a financial catastrophe. But that phones shouldn't fall into this category. So in my opinion, when the thought of losing your phone and having to replace it really worries you financially, your phone is probably too expensive. And I made a whole video about the benefits of having a cheaper phone. You can check it out here if you're interested. And finally, you could also do something like self-insurance, where you deliberately save the amount of money you would otherwise pay for insurance. And therefore, when disaster eventually does strike, you'd have some sort of phone emergency fund, and you could use that to buy a replacement. Alright guys, that's it for today. I hope you found that video helpful, and see you in the next one. Cheers!